Hello, this is Kahlil Adam, head investor at Itaú Private Bank, and I would like to thank you for joining us once again for the International Markets Update for June 2023. During last month's video, I focused primarily on the impact of the United States debt ceiling negotiation. As expected, early this month, U.S. politicians came together to avoid a costly default by the government. Global equity markets enjoyed a strong month following the resolution, led by U.S. markets, which rose intra-month approximately 5% to the highs of the year. While the market has given back some of these gains, they continue to trade into semester end near the highs of the year. That said, the focus for market participants has returned squarely to the fight that global central banks are in to contain inflation. The big question remains: will central banks, and especially the Fed, be able to orchestrate a soft landing and manage to tame inflation while avoiding a deep recession? Or will they have to stifle the economy via more restrictive monetary policy for longer and lead to a recession in order to remove the risk of inflation remaining high, or worse, spiking again? While some central banks, namely the Bank of England, have chosen a more hawkish path, surprising markets by raising rates by 50 basis points in June, the Fed chose not to hike this month. Inflation has slowed notably in the U.S. to 4%. This is still short of the 2% target for the Fed, and there is much debate about whether they will have to resume rate hikes in the near future, potentially as soon as next month. On the other hand, there's a case to be made for them to remain on hold for longer. As inflation continues to slow, leading indicators, especially on the manufacturing and housing front, as well as overall market liquidity measures, which have slowed, point to a weaker U.S. economy and further weakness in inflation. On the other hand, unemployment remains very low. Wages are strong, and therefore cost pressures for companies are high. As long as the consumer demand remains strong and healthy, and companies are able to raise prices to offset cost pressures, the risk of inflation picking up again remains relevant. The path through which inflation is ultimately contained is very important to equity markets. In the event the Fed successfully orchestrates a soft landing, consensus believes that there may be follow-through to recent price strength, whereas if there is a hard landing, company earnings will likely suffer and there would be downside from current levels. Our investment committee is currently neutral developed market equities and looking for signs that indicate more clearly what type of landing we are headed for. The one certainty we have is that the Fed, along with its other central bank counterparts, are determined to bring inflation down to more acceptable levels than current readings. In the event you have any questions, please reach out to your banker or investor. Thank you for joining us, and see you next month.